Good evening, everyone. Hope you all are doing well. On behalf of NISM, I, Kiranjit Kaur, welcome you all and take this opportunity to introduce today's speaker, Mr. Joydeep Sen, for this webinar on the topic Fixed Income Securities. Mr. Sen has worked in the financial services industry for 25 years, performing lead roles at various renowned institutions like PNB Paribas, etc. He also writes columns regularly in various financial publications and till date has published 458 articles in popular publications like Mint, Money Control, Financial Express, ET Markets, ET Online, Outlook Money, Cafe Mutual, The Hindu, Hindu Business Line, etc. He appears on CNBC Mutual Fund show at least once in 2 months. Further, to his credit, Mr. Sen has also authored 4 books, namely Fixed Income Markets in India, Investment Opportunities for You. Second, Mutual Funds in India, Vehicle for Fixed Income Investments. Third, Open Your Eyes to Management Lessons Around Us, and Wealth Management and Financial Planning and Wealth Management Concepts and Practices. Adding to his excellence, Mr. Sen has done trainings for CRISIL, FPSB, NISM, CIEL, and certain mutual fund houses. He is a visiting faculty at SBM NMIMS Mumbai. Academically, he is an MBA from Jadavpur University, Kolkata. Mr. Sen is also a certified financial planner. Mr. Sen has been awarded 100 most influential BFSI leaders by BFSI Congress in February 2019 and 2023, and 50 most influential financial services market professional at Financial Services Marketing Summit in 2019, 2021, and 2022. We heartily welcome you, sir, and over to you.
Thank you, Kiranjit, for the wonderful introduction, and good evening to all the participants. Am I clearly audible? Is the audio video working properly?
Yes, sir.
Sure. So I will now start sharing my screen and do the description along with. Just give me a minute. I will do the screen share. Yeah. Is the screen visible?
Yes, sir.
Okay. So what I will do is I will present an overview of the fixed income securities market. Now, what is this fixed income securities market? Obviously, the market for fixed income securities. And what is fixed in this within quote fixed income? It is the coupon or the interest rate. Because otherwise, in the secondary market, prices move every day, like any market, be it equity, be it commodities. In the bond debenture market also, prices move up and down every day in the secondary market. Otherwise, in a fixed income instrument, the coupon or interest rate is defined as a percentage of the face value, and that does not change, which is why globally it is known as fixed income. In India, both the terms are used. One term is fixed income and the other term is debt market or debt instruments. In India, the terms are interchangeable. So now let's start looking at the contours of the fixed income market. If you look at it globally, the forex market and the bond market are much bigger than the equity market. In India, however, the equity market is bigger. I'm giving you a perspective of the global scale. To my left-hand side, you see this size of the bar, the forex market, which is much bigger. Then we have the global bond market size, which is marginally higher than the equity market size. The comparison is not fully correct because if you look at it, if you can see my cursor, for the forex thing, it is the annual trading value. And for the equity and bond market, if you can see my cursor, it is the market cap. So traded value and market cap are not a correct comparison, but at least it gives you a perspective that the forex market is significantly larger than the bond and equity market globally, not in India. And for a perspective, the US GDP is $21 trillion. As against the size of the US GDP, which is $21 trillion, you see the size of the global bond market cap, and the global equity market cap, and of course the forex market traded values. I will show you similar data from another source because the authenticity or correctness of the data varies from source to source. So from PIMCO, now PIMCO is the largest bond house in the world, Pacific Investment Management. Look at the size of the circles. The global bond market is $157 trillion and the equity market is $98 trillion. The numbers in the previous slide and this side vary, but again, as I said, it is the function of the source from which data is taken. But net, the point to drive home is that Globally, the forex and equity market are larger than the forex and the bond market are larger than equity. But in India, somehow the equity market is larger than the bond market, at least in terms of secondary market traded value. We will discuss in terms of data in some time, that in terms of resources mobilized in India, actually the bond market is bigger, which is different from public perception or popular perception. I'll discuss some numbers in some time. So now I present a perspective on the relative size of the global bond market. Obviously, the US being US, it is the biggest one. So you can see, if you can see my cursor, the blue one. This one shows the US bond market size is $51 trillion, which is the biggest. In China, this orange one, $20 or $21 trillion is large. Then we have other large markets like Japan. We have the European countries like UK, France, Germany, and all that, Australia. And you see India here, relatively small, $1.3 trillion. But yes, the market is growing on the global scale. As of today, the Indian bond market is on the smaller side, but the market is growing. Now we come to the Indian market, and in the Indian market, this shows from the perspective of the issuers. Sovereign as in government, the government issues bonds. Then we have the public sector entities, public sector companies, and public sector entities, and we have the private sector issuing bonds. Within sovereign or within government, there's a bifurcation, central and state. So the central government issues papers, which are popularly known as government securities, or GSECs, as we call it, or some people call it government bonds. Within government bonds, we have GSECs and T-bills. Both GSECs and T-bills are issued by the government. The difference is GSECs have a maturity of more than 1 year, at least when issued. The maturity is more than 1 year. And T-bills, the maturity is less than 1 year, like 3 months, 6 months, 1 year is the maturity of T-bills. Then we have state governments. They issue the state government securities. These are typically called SDLs, as in state development loans. So in a conceptually similar, the central government issues GSECs or government bonds, and state government issues state government securities or SDLs. However, there is a fine difference here. There's a nuanced difference here. Government securities, be it central, be it state, is safe, being government security. But the difference is that the central government, they can do anything. The central government, they can print money, they can impose taxes. State governments can impose taxes, but it is limited. And the state government cannot print money. However, both central and state papers are sovereign securities as defined by the Reserve Bank of India. And SDLs or SGS, they are as safe as the central ones. The logic being the cash flows of the state governments flow through the RBI, and RBI has control over it. And in case there is an issue, any doubt about servicing of a state government paper, the RBI can dip into that flow of money and service the debt. Coming to public sector, there are government agencies, there are public sector companies, there are government banks or financial institutions. And what are the instruments they issue? The government agencies may issue either simple bonds or debentures, which may or may not be guaranteed by the central government. If they're guaranteed, the credit rating will be higher. It is called SO or CE rating, CE as in credit enhanced. There are government companies. So PSUs, they issue bonds or debentures of maturity more than 1 year, and they issue commercial papers which are of maturity less than 1 year. Then there are banks and financial institutions. So banks issue bonds or debentures of maturity more than 1 year, and they issue CDs, which is certificate of deposit, which are of maturity less than 1 year. Financial institutions can issue CDs of maturity 1 year also, 1 to 3 years, but bank CDs are of maturity less than 1 year. Coming to private sector, we have corporates and we have private sector banks. So corporates issue debentures or bonds. The terms are kind of interchangeable, which are of maturity 1 year, and CPs which are of maturity less than 1 year. Private sector banks, they issue CPs or CDs. So private sector companies or NBFCs, they would issue CPs, and banks would issue CDs. So to summarize this slide, the term bond or debenture, they may have a fine nuanced difference, but practically they are same. The terms are interchangeable. The government issues GSECs or government securities or government bonds. State governments issue SDL, which is state development loan, or state government securities. Both are sovereign. The corporate sector, both public and private sector, they issue bonds, debentures, maturity more than 1 year. CPs are issued by non-banks, as in corporates and or NBFCs. And CDs, which is certificate of deposit, are issued by banks, be it PSU or be it a private sector bank. Moving on, so this shows a glimpse of the market participants. The entire market in India is made of these market participants. So who are the ones? And let us see what is the role of these various market participants. The central government, what does the government do? The government issues what I just said, government securities. And why do they issue government securities? The government budget perennially has a fiscal deficit, and the fiscal deficit is financed largely by borrowings from the market. And these borrowings are nothing but the issuance of the government securities. So much of the fiscal deficit is financed through issuance of government securities of maturities whatever, like 5 years, 10 years, 15 years. So that is the primary role of the central government. There are certain charitable trusts who have their money, and as per their mandate, they would invest in either government securities or maybe highly rated private sector, public sector bonds also. Reserve Bank of India has multiple roles in the market. I will tell you about regulation. So Reserve Bank of India kind of acts as the merchant banker for the government securities issuance program. The huge government borrowing program, the RBI not just controls banks, but they also manage the government securities program. So there is an issuance calendar announced by the RBI every 6 months that gives the maturity bands and the quantum to be raised through auction every week, every Friday. Primary dealers are entities promoted by banks, so they have a specified role in the market. They are wholesale market participants. In the primary auction process of issuance of government securities, they have to underwrite the issuances in case it is not purchased, in case it devolves on them. They have to purchase that much of quantum, and they lend liquidity in the secondary market for government securities. State governments, as we just said, they issue SDLs or SGS, that is State Development Loan or State Government Securities. PSUs, they issue bonds, debentures, and PSUs, in case they are surplus, they would invest the surplus money in bonds, debentures. There are corporate treasuries. Now, corporates work on both sides. Corporates raise resources through issuance of bonds or debentures, and if there is surplus treasury, they may also invest in bonds and debentures. Insurance companies, they are big investors because insurance companies include LIC, and of course, the private sector ones also are reasonably large. So they are big investors in the bond, debenture, fixed income market, and they may also issue occasionally bonds and debentures. Banks are the largest investors in the market because banks are huge. There are nationalized PSU banks, there are private sector banks, they are big, and they invest money in bonds and debentures, in particular government securities. Financial institutions, they are mostly issuers in markets, and if they have surplus money, they may invest as well. Mutual funds, as you know, they are investors. So mutual funds take public money and they invest as per the mandate of the particular fund. They invest in corporate bonds, CPs, CDs, government securities. Foreign institutions, they are investors. I'll show you some numbers in some time. The quantum of investment by FIIs is not as large as it is popularly perceived. There are provident funds who invest their money as per the mandate, mostly in government securities, maybe in highly rated corporate bonds or PSU bonds also. Now we come to a sense of getting the market size. If you recall, I said sometime earlier that in terms of resources raised, the fixed income market in India is actually larger than the equity market. Let me give you some numbers here. So what you see here on my right hand side, this 150 lakh crore, this 150 lakh crore is the quantum of money raised through government securities. Now look at these numbers. GSEC as such, 87 lakh crore. We have no special GSEC rupees so much. There are 14 government securities so much. These are of maturity more than 1 year. Then we have T-bills, treasury bills of 8 lakh crore. And we have the SDL or SGS of 47 lakh crore or 48 lakh crore. Uday bonds are a version of SDLs, a category of SDLs. Add up all these, we have 150 lakh crore of quanta mobilized as on March 23 by the government sector. It is central government and the state governments. And we have the private sector corporate bonds. Now, mind you, PSUs also come under the corporate bonds and not in the government securities segment. So these are pure government securities. So approximately 40 lakh crore of corporate bonds, including PSU companies. So approximately 190 lakh crore, 200 lakh crore is the quantum of money mobilized through issuance of securities, fixed income securities. Now, what is the size of the equity market? So taking the size of the equity market, somewhere around the GDP of the country. The GDP of the country is approximately 270 lakh crore. So somewhere around maybe say 250, 260 lakh crore is the equity market cap. Now the point is this 250 lakh crore, 260 lakh crore is the equity market cap, not the quantum of resources mobilized. There is no hard and fast number. There is no authentic data on that. Taking a ballpark of 20%. So what I'm trying to say is, let's say a company issues shares of face value, say rupees 100. The market price becomes 100 rupees. But in this case, the company has got 10 rupees only and not 100 rupees. 100 rupees is the market price. But in the primary market, the company got 10 rupees only. Now, taking a ballpark of 20%, if the equity market cap is say 250 or 260 lakh crore, the corporate sector, through issuance of equity stocks, they raised only 20% of that. As against that, these numbers, like government sector, are at 40 lakh crore of corporate bonds. 190 to 200 lakh crore is the actual amount of resources raised by issuance of fixed income securities from the market. The table below gives you a relative size. So in this outstanding quantum, like you see on the upper portion, 62% in government securities as such, 5.5% is treasury bills which are of maturity less than 1 year, and about 33% is SDLs. So obviously the predominant component is government securities because the central government, they have a large budget size and they have a large borrowing quantum, which is why the GSEC quantum is higher than SDLs. Now we come to corporate bonds. The size of the market in India is not as large. So you see here like Korea, Myanmar, China, Thailand, India. So in India, as a percentage of GDP, this number is 20%. So here we have Korea is like 80% plus. In India, it is like less than 20%. So as of today, looking at the size of the market in terms of it was mobilized, it is not as large, but the market is growing, and gradually we will develop further. So we have other Asian markets also which are smaller in terms of mobilization, like Vietnam, Japan, Philippines, Indonesia, and all that. Continuing on the corporate bonds, the corporate bond outstanding as a share of GDP. So in this graph, the blue bars represent the corporate bond outstanding, which is in rupees lakh crore. So approximately 40 lakh crore is the quantum. So approximately 40 lakh crore of outstanding corporate bonds, and the orange bars represent the GDP. So till FY22, GDP was like 230 to 40 lakh crore. So 23 is like around 270 to 280 lakh crore is the GDP. So as a percentage, as you see here, A by B, as in corporate bond outstanding divided by GDP, we have this percentage on the right-hand scale. The quantum is rupees lakh crore on left-hand scale, and this 0.2, 0.1 is the percentage on the right-hand scale. So as a percentage, we have like approximately 17% of GDP. Now, FY21, what happened? We see this quantum moving up. So FY21, because of COVID, because of lockdown, GDP as such came down. We had a negative growth of 5.8% in GDP. And the quantum of issuances went up because of some other reason, because RBI had the schemes of LTRO and TLTRO. So as a percentage, it went up. And again, then FY22, GDP normalized, we had a positive GDP growth of 9.1%. So as a percentage, this came down. So as a ballpark, we have like 17, 18% of GDP in terms of corporate bonds, bond issuances in quantum. Continuing further on corporate bonds. So we have the outstanding quantum, see it is moving up. So while on one hand, as a percentage of GDP, it is not as much as certain other Asian economies, the quantum is moving up. So as we saw in the previous graph, so this percentage is moving up. So FY11, it was like somewhere here, 12% or something. And now it's like 17% or something. On one hand, GDP as such is growing, and corporate bond issuance quantum also is increasing. So things are improving. And here we see the quantum of issuances. So from approximately 10 lakh crore in 2012 to approximately 40 lakh crore now, 22 or 23 will be marginally higher. So 41 lakh crore, 41 lakh, 42 lakh crore is the outstanding quantum of corporate bonds. On the right hand side, I'm showing you the quantum issuances in a particular year. So what we see here, this 40 lakh crore is the cumulative outstanding quantum as on a particular date. And what we see on my right hand side is the quantum of issuance in a particular year. So what we see here, so like in FY 2021, FY21, the outstanding quantum went up, as I said, even though the economy was not doing well because of COVID, because of lockdown and all those things, the economy was not doing well. And the corporate sector, they were not really investing in fresh capacities. The quantum of issuance went up because of some other reason, because the RBI had some schemes, all this LTRO, TLTRO, and those schemes. So it went up. And FY22, things normalized and the corporates did not issue as much. Another thing to note here is, if you look at it, the public issuance and private placement. So as you can see, the relative size of the markets or size of the issuances, 95 to 98% of the issuances happen through the private placement route, and only like 3 or 5% happens through the public issuance route. Why so? The market is largely wholesale. So typically how corporate bond issuances happen. A corporate which wants to raise resources, issue corporate bonds, they would approach a merchant banker and discuss with the merchant banker at what rate it may be mobilized. And once they decide the rate, it is the merchant banker's job to approach investors and get the money. Now, these investors, as I said, are largely wholesale. It could be banks, it could be insurance companies, it could be mutual funds, it could be corporate treasuries, but not typically retail individuals. They are the big boys of the market. So given the wholesale nature of the market, and also less of management and less of other hassles, less of issuance cost, the corporate would simply engage the merchant bankers, and the merchant bankers would raise the money from the wholesale market, which is why you see this blue component of the bar is the largest component, and money is raised largely through issuances through private placements. Now, if you have tracked so much, recently you would have seen that the quantum of or the number of public issues have moved up. So recently there are quite a few companies which are hitting the market. So companies, so on what is happening is GDP is growing, the number of companies are growing, and the number of companies that want to issue bonds are growing. So we see the number of companies raising money through public issuances also are moving up. Cinema, it is good, expansion of the market, expansion of the base. And as more and more companies come into the public issuance market, that is where people like you and me, retail individuals, we can get to invest in the primary market. Moving on from this slide, what we are showing you here is the composition or nature of trades in the secondary market. In the secondary market, the trades that happen mostly in government securities. So this is little old from NSE annual report, FY22. So as you can see here, 55% is government securities as such, and 32% is treasury bills. So when we combine 55.4% and 32.5% taken together, about 80-90% is the government sector itself. So why so? The government securities having no credit risk, they are the best quality fixed income securities, and the wholesale market participants or the institutional sector participants, be it banks, be it mutual funds, be it insurance companies, or be it other corporate treasuries, market participants, they feel comfortable in investing and trading in the government securities, be it DSEC as such, maturity more than 1 year, or treasury bills. The other components of the market, they are not as high traded, so the market is not as liquid in those segments. As you can see here, corporate bonds, so much percentage, 7.66%. We have bank bonds, we have institute bonds, PSU bonds, and all that, which are relatively small. So whatever liquidity we have in the secondary market is largely 80-90% the government sector, and the balance is the corporate sector. Some more idea about traded quantum in the secondary market. So here the blue bars represent the average daily traded volume on the left hand side. As you can see, the numbers like 8,000 crore, 6,000 crore. This is approximately the traded quantum on a given day, on a working day. So 1920 so much, 1922 so much, FY23 up to a particular date, up to 2022, we have FY23 data. So approximately 6,000 crore or 8,000 crore is the typical traded quantum on a given day. And as you see this orange line, the average daily trades have been going up. So left hand side, left hand scale, we have rupees crore, and right hand side, we have the number of trades. So number of trades have been moving up, which means the trade lot traded is coming down, which is why the overall traded quantum has been coming down, which means more market participants trading in smaller lot sizes. Just give me a moment. Okay. Now coming to who owns these government securities or other securities in the market. Like in a equity stock, a company has a shareholding pattern. Who owns the equity shares of the company? Similarly, we discussed for these various bonds or debentures, who owns or who purchases these securities. This is GSECs or government securities or central government securities. So as you can see, this is the quantum, which is like 93 lakh to 94 lakh crore, the quantum of government securities. And the largest owner is commercial banks, basically banks, as we say, PSU banks and private sector banks. So about 38%, you can see the first line here, about 38% of the outstanding quantum of government securities is held by banks, PSU and private sector banks. The next highest is insurance companies, I can see here, 26%. And why it is so big? As I said, insurance companies include LIC, and LIC is huge. And of course, the private ones also are reasonably large. So banks, they are the biggest holders of government securities, 38%. We have insurance companies, and the third largest will surprise you, about 15% is RBI itself. So RBI does certain operations in the secondary market. So RBI, as a matter of rule, they cannot buy primary market DSECs because RBI acts as the merchant banker. But in the secondary market, RBI does operations, what is called OMO, that is open market operation, and RBI does purchase government securities. So due to these, RBI itself is the third largest holder of government securities, approximately 15%. Who are the others? Now look at this, FIIs, foreign portfolio investors, the number 8 here, is only 1.31%. And this is contrary to public perception, because people tend to believe that if FIIs and FPIs are important, but not so. Look at the number, FPIs hold only 1.31% of the outstanding quantum of government securities. There are limits, of course, like I think, if I recall correctly, 6% of the outstanding quantum. But even within the limit of, say, 6% of outstanding quantum, they hold only less than 1.5% of quantum issue. Who are the other ones? We have provident funds. They have like 4.5% of outstanding quantum. And we have presence from mutual funds, about 3%. We have cooperative banks, institutions, and corporates who have small quantum of ownership. State governments also own a certain bit, which is like about 2% of outstanding quantum. Now coming to SGS, state government securities. It's a similar situation. Banks are largest, 34%. Insurance companies, second largest. Insurance companies including LIC. Provident funds own 20%. Now here you see RBI is small. RBI is only 0.75%. Because those market think that OMO, open market operations, that they do in central government securities only, not in state government securities. They can do it, but usually they don't do it. The larger ones, banks, insurance, provident funds, plus we have some extent of primary dealers, some extent of mutual funds, which is like about 2%, cooperative banks 3.8%, and all that. And then we have state governments also. I mean, cross ownership, so only 0.24%. Now coming to T-bills, treasury bills, similar picture. Banks hold half of it. Mutual funds 14%. Look at the difference here. In central government securities, mutual funds have only less than 3%. In state securities, mutual funds have like 2%. But in T-bills, mutual funds have 14%. Because all these liquid funds, money market funds, they have significant amount of money. And that money, I mean, part of the money is invested in these treasury bills. 14% is held by mutual funds. Plus we have others, including state governments, around 13%, because state governments have separate amount and they invest in state government, in T-bills. So we have cooperative banks, institutions, and all that. And FPIs, they hold only 0.5%. So FPIs, both in central and SGS and treasury bills, they are a small player. Now coming to corporate bonds, this data is old. It is 5-year-old data. I'm showing it because I could not get latest data. But we at least get a perspective from this. So as per this data, which is whatever, little old, 5-year old, you see mutual funds are the largest one, FY18. As on FY18, mutual funds held this much, the top component, the gray component. Then insurance companies, then we have EPFO, trusts, NPS, which is National Pension Scheme, foreign portfolio investors, banks, and others. Now, why this difference? In mutual funds, government security funds are not as big in terms of money, in terms of AUM, whereas the other funds, corporate bond funds, other usual funds, they have a larger quantum of money. So mutual funds are a major player in the corporate bonds market. And of course, insurance companies, LIC, they have a significant quantum, and banks are not as large here, like we see here, this much of component. So you would have noticed in central SGS, T-bill, banks are the largest, but in corporate bonds, banks are there, but they are not as large. Some nature, some color of the market. In the market in corporate bonds is largely top quality oriented. So as you can see the numbers here. Issuances, primary issuances are mostly AAA. So if you can see the numbers here, FY20, AAA issuances was like 5 lakh crore, AA plus was like 33,000 crore, AA was like 38 and all that. There's a big difference. So 5 lakh crore for AAA and AA plus is 32,000 and AA is only so much. There's a big difference. So across financial years and first half of FY21, there's a big difference. The reason is when a company comes to the market to issue bonds, if it is not AAA, number of takers are only a few. However, if you look at the composition of the outstanding rated universe of agencies like CRISIL, ICRA, CARE, they are the credit rating agencies. If you look at the outstanding universe, they are mostly BBB or even less than BBB. However, they cannot come to the bond market because nobody will buy their bonds. They have to go to banks and banks only for raising resources. AAA companies, they have a choice. They take money as in loans from banks also, and they issue bonds also from the market as we are seeing here. Who are the regulators? Regulators are RBI and SEBI. So who regulates what? So RBI, as I said, they are kind of merchant bankers to the government securities issuances program. RBI regulates banks, control banks, and also manages the government securities borrowing program. So there are these weekly auctions conducted every Friday. So they give a notice on the RBI website. People bid, people as in all these banks, mutual fund, insurance companies, corporations, they will bid. And every Friday, the primary auction happens for issuance of government securities. RBI also acts as the regulator for the money market and the government securities market. And instruments issued by commercial banks are institutions of less than 1 year maturity. And what is the role of SEBI? SEBI, as you know, regulates the equity secondary market, the equity market, mutual funds. SEBI is the regulator for the corporate bond market, including instruments issued by banks and PSUs of more than 1 year maturity. So basically, G-SEC market governed or regulated by RBI, and the corporate bond market regulated by SEBI. Some more nature about the corporate bond market, some comparison. Trades in government securities take place over the NDS-OM platform hosted by CCI. Now, what is this? How do trades happen in the equity market? We have the exchanges, we have NSE, BSE. So you can open an account with a broker, and the broker, the NSE, BSE member, on your behalf, they will trade. And nowadays we have all the Zerodha and all. You can trade on the exchange through the apps. What happens is there is a platform provided by NSE, BSE on which you can trade through a NSE, BSE member. Now, in government securities, how do trades happen? So CCIL is Clearing Corporation of India Limited. Clearing Corporation of India Limited hosts this system called NDS-OM. NDS-OM stands for Negotiated Dealing System Order Matching Platform. So this is an anonymous code-driven order matching system. Now, what is this? So as you know, in the NSE or BSE system, when you are trading, you can, on the system, on the terminal, you can see the top 5 buy quotes, top 5 sell quotes. You do not see who is the people, who is the entity behind that. It is anonymous. That is how it is structured. You don't know who is trading, who is giving that quote behind the system. Only the system knows it. So it is anonymous. Similarly, NDS-OM system, where G-SECs are traded, that is anonymous. It is code driven. Like you see in equity, you see the top 5 buy quotes, sell quotes. When the quote matches, automatically the trade is executed. Same thing happens in this. So in this CCIS system, NDS-OM, who are the members? As we discussed, the people who typically invest and trade in government securities, which is banks, insurance companies, mutual funds, corporate treasuries, the big boys of the market. Some trades take place through NSE, but to a very small extent, trades happen mostly through this NDS-OM platform, which is where all the banks and insurance companies trade government securities. And as we saw, there is a fair degree of liquidity. Whatever liquidity is there in the secondary market is largely concentrated in G-Secs and T-bills. Who are the investors in G-Secs? Banks, insurance companies, sovereign fund trusts, corporate treasuries, mutual funds, and the like. As against that, trades in corporate bonds take place on the voice market. Voice market means the telephone market, which simply means it is not like how equity shares are traded. There is a system like NSE, or how G-Secs are traded, a system, NDS-OM. You come and put the code there. It does not really work that way, even though these corporate bonds are listed. So in a way, it is a small market in the sense people know each other. People will call up each other. I want to sell, I want to buy, or they may go through an intermediary. And when the thing matches, they will negotiate on the level. So when I say level means the YTM or the yield to maturity. So when they negotiate on the yield, it matches and the trade is finalized. Liquidity in the corporate bond is lower than G-Sec market, like we saw some numbers earlier. For a trade, market participants talk to each other or go through an intermediary. Now look at this. Settlement happens mostly on the trade reporting and settlement system of NSE and BSE. How do equity trades happen? When you trade a share through a broker, which is NSE BSE member, through NSE or BSE, the settlement also happens to the system of NSE or BSE. Now in the corporate bond market, mostly 90%, the trade negotiation happens on the phone or the voice market. Now, NSE and BSE, they provide a platform, they provide a system for reporting and settlement of the trade, which is where most of the reporting and settlement happens. How does it help? It does away with the counterparty or settlement risk, because it is being routed through the NSE or BSE settlement system. Some trades do happen on the NSE BSE platform, but that is on the lower side. More than 90% of trades in the corporate bond market happen through the voice market. So what is the difference in the secondary market of G-Secs and corporate bonds? One is the traded volume. So on a typical day, G-Secs trade like around 40,000 crore. Just a number, 40,000 crore, can be maybe 50, 60, 20, 30,000 crore, whatever. As a ballpark number, G-Secs trade like say 40,000 crore on a day, and corporate bonds have to have the numbers here, 6,000 crore or 7,000 crore on a given day. So one is the quantity, the volume of trades or value of trades in the secondary market. The nature of participants are similar in a way that both the markets are wholesale or institutional investors. But in the corporate bond market, we have a relatively higher participation of mutual funds and HNIs, like we saw the numbers here earlier. In G-Secs, mutual funds have like 1%, 2% ownership. In corporate bond, they have like 15, 20%, more than 20% ownership. And HNIs also, with the development of the market, HNIs also are finding on the lower side, but increasing participation in the corporate bond market. The other this thing is OTC, that is over the counter. So corporate bond trades are mostly OTC, like we said, on the voice market or phone market, executed verbally and formalized through the NSE BSE settlement systems. G-Sec trades are exchange driven, like I said, in a way the CCIL NDS-OM system operates like the NSE or BSE system for settlement of or execution of trades in the equity market. Some more differences, number of securities. Now in G-Secs, like we saw earlier, the quantum of issuance is huge, like 92 lakh to 93 lakh crore, which is higher than any other this thing. We talk of equity market mobilization, we talk of corporate bonds, it is higher than anything else. Corporate bonds, 40 lakh crore, G-Sec like 92 lakh crore, the biggest. However, when we look at the number of securities being issued, it is not as large, let's say 100 or thereabouts. So how is it that they have raised, the government has raised so much of money, so much of value through only 100 securities? So what they do, something called consolidation of securities. So what they do is, when they raise fresh money, they will do a reissuance of a particular security, a particular ISIN, ISIN as in International Securities Identification Number. They will do a reissuance of a particular ISIN, so they raise more money, so that the number of securities is not increasing, but the quantum mobilized, the value mobilized is increasing. So how it helps? It helps in market consolidation. and also helps in market liquidity, because when you have so much of outstanding quantum of particular security, you have a larger investor base, and so the liquidity moves up. Then the difference is in the nature of the securities. In G-Secs, all securities are government, so no credit risk any which way. But in the corporate bond market, we have all over, like AAA, AA, single A, triple B. Triple B is the minimum investment grade, so we have less than investment grade, maybe if they have some issuance. So across the spectrum, AAA, AA, single A in corporate bonds. So the nature of securities, the quality of the securities vary in the corporate bond market, which is not so. G-Secs are of course government securities. T-bills also are issued by the government, and STL also. Now, arguably, the fundamentals, financials of states vary from state A to state B. However, in the market, difference is minuscule because the market looks at it as sovereign, which is actually sovereign, because RBI says state government securities are sovereign. So in a way, the quality of the issuers in SGS also are similar. Now, non-wholesale means what? Retail. Now, so far I have been saying that the market is largely wholesale, largely institutional. Investors are people like banks, insurance companies, cooperatives, mutual funds, who are like big boys, not people like you and me. So how do people like you and me, how do retail, how do we participate in the market? So initiatives have been taken. So for the G-Sec market, initiatives are taken earlier, not really successful. So the latest this thing is something called RBI Retail Direct. So this is a platform initiative taken by the RBI. Anybody, any individual, not companies, only individual. Individuals can access the system, go to the website, open an account, and can access in retail lot size. So quantum is rupees 10,000 only, which is very retail. So what do you have to do? You visit the website, open the account, and transfer money from your bank, which is as simple as that. So just to give a bit of technicals, for trading in government securities, there is a requirement of something called CSGL account. CSGL stands for Constituent SGL, Subsidiary General Ledger. So there is a system of conversion of a government security from CSGL to DMAT. But in this system, this RBI Retail Direct, no headache, no nothing. RBI takes care of everything. Don't even require a DMAT account. It is held by the RBI on your behalf. So what can you buy there? You can buy G-Secs as such. You can buy T-bills. You can buy SDL, which is state development notes, state government securities. And you can also buy the sovereign gold bonds. And what can you do? There is this primary issuance, primary auction of government securities. You can bid for primary auction. You can buy in secondary market. So in the secondary market, the RBI will participate on your behalf for your quantum in the CCIL NDS OM system. You can buy secondary market. You can sell secondary market. You put the quote on the RBI system, RBI RDG system, and on your behalf, RBI will accumulate all the orders, all the quotes, and put in the CCIL NDS OM system. So this is a good initiative taken by RBI for allowing retail participation, 10,000 kind of lots in the G-Secs market. Then we have the investment vehicles like mutual funds. So mutual funds, you can invest small quantum, like 5,000 rupees is the minimum ticket size for investment in mutual funds, apart from SIPs. So when you buy a government security fund or a debt fund like a corporate bond fund, target maturity fund, or a short duration fund, that mutual fund invests the money in corporate bonds or other securities. Now, when you buy one unit, you are buying only so much. The mutual fund on your behalf is participating in the wholesale market. Otherwise, the market is, participants are like banks, insurance companies, the big ones. So in the wholesale market, the mutual fund is participating on your behalf. Plus, we have other vehicles. We have AIFs, that is alternative investment fund. We have PMS, that is portfolio management service. They also participate in the wholesale market. But the point is, in AIF PMS, the minimum quantum is higher side. PMS minimum 50 lakh crore, AIF minimum 1 crore rupees. So it is not really as retail in that sense as mutual funds. What else do we have? We have the bond houses, we call them bond houses. So there are like brokers or NFCs in the market, we refer to as bond houses. So they make corporate bonds available, I won't say retail, but not like, so usually in the wholesale market, the typical lot size is 5 crore rupees. A G-Sec or corporate bond in the wholesale market trades for like 5 crore, 20 crore, maybe 1 crore also, 50 lakhs also. But typical quantum is like 5 crore rupees. Now, in this market, when I say a bond house, what they will do is they will source the bonds from the wholesale market in lots of like whatever, 1 crore, 5 crore, whatever. And they will downsell to their investors who are like HNIs or mass affluent or higher end of retail in lot size of say, let's say 10 lakh rupees or 1 lakh rupees, which is not exactly retail, maybe say 1 lakh, 10 lakh kind of lot sizes. They will make it available to retail or mass affluent segment. But in a way, they are making it available to the non-wholesale market. Now, we have this, what is called OBPP, that is online bond provider platforms. So what they do is they have their inventory sheet, the corporate bonds with them. They make it available online. You can go to their system, become a member to the basic KYC and all, and you can invest in bonds online. So they are not exactly an exchange like NSE, BSE, but in a way they are making it available. And SEBI has issued guidelines for this OBPP so that it is properly regulated. Then, of course, we have the exchanges, NSE, BSE, corporate bonds are listed there. Now, the whole issue is that now in equity stocks are listed. You simply buy and sell through the exchange, through NSE, BSE, through an NSE, BSE member, which is a broker. The issue in corporate bonds is that even though these are listed, there is lack of liquidity in the secondary, as in the NSE, BSE secondary market, which is why you have to go through either a bond house or OBPP or a vehicle like mutual fund or something, because of lack of liquidity in the secondary market of corporate bonds. So that is about the overview. So we'll do Q&A as of now. Just to give a brief of this certification, we have this NISM series 22, which is fixed income securities certification. It's 100 marks, this thing, total 85 questions, 70 questions of 1 mark each and 15 questions of 2 marks, passing score 60%, validity 3 years, and negative marking is there about 25%, as in if it is +1 for 1 correct answer, it is minus 0.25 for 1 wrong answer in 2 hours. You have to answer this question. So it is meant for whom? So even though I have been saying that the market is wholesale, the market is developing, the issuance quantum is increasing along with the increase in size of our GDP. Participants also are increasing. So all these institutional market participants, be it mutual funds, banks, corporate treasuries, insurance companies, they require dealers. The bond houses require dealers. So the market is growing. So any professional associated with this fixed income securities market, typically in dealing and all, should ideally clear this certification. Or any student professional who is looking to gain knowledge in fixed income securities can go through this certification. So what does it cover? Basics of Indian debt market, terminologies, classification of securities, like I touched a little bit of it, like issuer, like government, private sector. Maturity, maturity given like 5 years, 7 years, or perpetual maturity. The coupon, which is the interest rate. There are certain put call options and all that. What are the risks in fixed income securities? The pricing of bonds, like yield and price, how does it move? The YTM and current yield, all these measures. The concepts of measuring the interest rate risk, or the concept of macro duration, modified duration, the money market composition, the government securities market composition, corporate market composition, all these things are covered in this thing. So I think I will pause here and minimize my PPT. Should I minimize my PPT before we take questions? Should I minimize my, stop sharing my screen?
Yes, sir. Now we can take up questions. We have only 2 questions.
Okay.
From the candidate's side. The question 1 is, how good are RBI floating rate bonds?
Okay. So that is a very good instrument. So what RBI floating rate bond says is that there is a base rate, which is the small savings rate, plus a markup of 35 basis point. It is a very good instrument because there is no credit risk there, because it is issued by sovereign, issued by the Reserve Bank of India, and the return also is good. So it's a typical saving instrument. It is good, but it is more like, what should I say, a financial planning or investment product. What we are discussing here is the typical fixed income securities market, secondary market trading and all that. Typically government securities, corporate bonds, which are issued in primary, but there is also secondary market for that. But yes, to answer your question, it's a very good instrument because there is no credit risk. Only thing is liquidity. So for any investment, you have to see one is safety, that is the SLR, safety, liquidity, returns. Look at the safety, look at the liquidity, and look at the returns. Returns on the higher side, safety, no issues, sovereign quality, but liquidity is the issue in RBI floating rate bonds.
Thank you, sir. The second question is, where do you think the Indian interest rate trajectory is heading?
Okay, that's a good question. So let me start with the global scenario, and then I will come to the Indian scenario. So globally, what has been happening is inflation has been much on the higher side, and central banks all over the world, be it the Fed, the Federal Reserve in the US, be it the ECB as in the European Central Bank or the Bank of England, including our RBI, all over the world, interest rates are being hiked because inflation has been on the higher side. However, as we speak, we are nearing or at the peak of the rate hike cycle. The reason is, even though globally inflation remains on the higher side, globally the health of the economy is not as good, which means if the central bank hikes interest rate too much, the ability or capacity of the economy to absorb higher interest rates is only so much. So without hampering the economy, without hampering the GDP growth of the economy, the central bank can afford to hike only so much. So globally, whatever rates we have today, like US Fed rate 5.25, we have ECB deposit rate 3.25%, we have Bank of England at 4.5%. These are near about the peak. Now, in this situation, when the global rate hike cycle is peaking or at the peak, at India also, we have peaked. So the official view from RBI is that, our inflation target is 4%, and we remain vigilant, and they maintain apparently the hawkish stance. The view in the market and my individual view also is that it has already peaked. The reason is that today we have repo rate at 6.5%, and for inflation, the latest declared number, CPI inflation is 4.7%, and WPI is negative, minus 0.95%. So given these inflation levels, it is very unlikely that the RBI will hike further. 8 June is the next RBI policy review. And also in India, also, even the growth is positive growth, GDP growth is decent. If the RBI hikes too much, that may hamper the GDP growth. So the view is that rate hikes are almost over. So where does that put us? In the fixed income securities market, where do you invest? You can buy corporate bond direct, like we discussed. You can buy through, be it the NISM system, be it through a bond house, be it through a OBPP. Whatever yields are available today are near about the peak levels. Or you can buy through the mutual fund route. So in the mutual fund, whatever YTM is there, YTM is in the yield to maturity, whatever portfolio YTM is there in the debt funds, that is kind of peakish. So in a way, these are good levels to buy. Now, there is another view in some segment of the market that the RBI may actually cut rates going forward. So it may happen, it may not happen. It all depends on the RBI, depending how inflation pans out, depending on RBI's reaction to whatever inflation is happening or not happening. Possibility, yes, but you never know whether the RBI will cut rates or not cut rates. So that briefly is the thing about the view on interest rates in India.
So concluding the session, thank you, sir, for informing our audience about the fixed income securities stream in India and informing them about NISM Series 22 fixed income security certification examination. I request my audience that for any queries pertaining to certification examination, you may log on to NISM's website, www.nism.ac.in, or call at 8080806476. Thank you, everybody.